The amount that landed in your bank account this month may not be the same thing as the Social Security benefit you actually earned, and that difference is where a lot of retirees get into trouble. A person can see a smaller deposit and assume Social Security cut the benefit. Another person can see a larger deposit and assume everything is correct. Both assumptions can be wrong. In 2026, several separate rules can change what finally reaches your checking account, including the cost of living increase, Medicare premiums, income-related Medicare charges, federal tax withholding, work earnings, corrections to your Social Security record, and recovery of money. Social Security says you were overpaid. These changes do not all work the same way. Some happen automatically, some require you to act, some can be challenged, some can be corrected. And one of the most dangerous mistakes I see retirees make is looking only at the bank deposit instead of asking why that deposit is the amount it is. Pay close attention to this, because before we are finished, I am going to show you the simple protection habit I would use every time a Social Security payment changes unexpectedly. It takes only a few minutes, but it can help you catch a problem before a small difference becomes months of lost money. I have spent decades studying retirement rules, taxes, banking practices, Social Security, Medicare, credit, and the way ordinary Americans get caught between systems that were never designed to explain themselves in simple language. And the first thing I want you to understand is that a Social Security payment is not one number. There is the benefit Social Security calculates for you. There can be increases added to that amount. There can be Medicare premiums taken from it. There can be federal taxes taken from it if you requested withholding. There can be money withheld because you are working before full retirement age. There can be an adjustment because your earnings record changed. There can be a deduction because Social Security says you were overpaid in the past. Then there is the final amount that reaches your bank. Those numbers can be very different. This is why simply saying, "My check went up," or "My check went down," does not tell me enough. I want to know what happened to the gross benefit before deductions, what was taken out, and whether any new adjustment appeared on the record. Think of it the same way you looked at a paycheck when you were working. Your salary might have been $4,000 for the month, but the amount deposited into your bank account was not $4,000. Taxes, insurance, retirement contributions, and other deductions came out first. Social Security can work the same way. The amount you see in the bank is the end of the story, not the beginning. That distinction became especially important in 2026 because Social Security benefits received a 2.8% cost of living adjustment. The Social Security Administration estimated that the average retired worker benefit would move from about $2,015 before that adjustment to about $2,071 after it, an increase of roughly $56 a month on average. That sounds simple. Your benefit goes up. You should see $56 extra dollars. But that is not necessarily what happens in your bank account. Medicare Part B changed at the same time. The standard monthly Part B premium rose from $180 in 2025 to $202.90 in 2026. That is an increase of $17.90 a month. So imagine a retiree whose gross Social Security payment increased by around $56, while the Medicare amount taken from the payment increased by $17.90. If everything else remained exactly the same, that retiree might feel an increase closer to $38 instead of $56 in the amount available to spend. That does not mean Social Security secretly took away the cost of living adjustment. It means two separate government calculations changed at roughly the same time. One raised the gross benefit, another raised a health insurance premium that many retirees have taken directly from Social Security. The bank shows only the final answer. Most people never realize this. They hear that Social Security increased 2.8% and immediately multiply last year's bank deposit by 1.028. That calculation can be misleading because last year's bank deposit may already have had Medicare, taxes, or some other deduction removed. If you want to understand whether your benefit was calculated correctly, compare gross benefit to gross benefit and deductions to deductions. Do not compare only deposit to deposit. And there is another reason. Two neighbors with similar Social Security benefits can see very different changes. Medicare Part B does not cost everyone the standard amount. For most Medicare beneficiaries, the standard Part B premium in 2026 is $202.90 a month. But people with higher income can pay an extra amount known as the Income-Related Monthly Adjustment Amount, usually called IRMA. I know that sounds technical. So forget the letters for a moment. Think of it simply as an extra Medicare charge based on income. For 2026, a person filing an individual tax return generally stays at the standard Part B premium if the income Medicare uses for this purpose is no more than $109,000. For a married couple filing jointly, the corresponding amount is $218,000. Above those levels, the monthly Part B premium can move into much higher brackets. Depending on income, the total Part B premium can rise to $284.10, $405.80, $527.50, $649.20, or even $689.90 per month. Imagine two retired couples who both receive about $4,000 a month in Social Security between them. One couple has very little other income. The other couple sold investments or received a large retirement distribution that pushed income into a higher Medicare bracket. Their Social Security benefits may be similar, but what reaches their bank accounts can be very different. And here is what almost nobody understands. The income Medicare uses can reflect an earlier tax year. That creates situations where a retiree is paying a higher Medicare charge now, even though the income that caused the charge no longer exists. I have seen versions of this situation many times. A man retires after earning $160,000 a year. The income on his tax return is high while he is working. Then he retires and his household income falls to $70,000. Months later, he receives a notice showing a higher Medicare premium based on income from his working years. He looks at the letter and thinks there is nothing he can do because the government has his tax return. That assumption can be expensive. If your household income went down because of certain recognized life-changing events, Social Security allows you to ask for a new decision on the income-related Medicare charge. Retirement or loss of work can be important in this process. So can marriage, divorce, the death of a spouse, and other qualifying events. Form SSA 44 is used for what Social Security calls a Medicare income-related monthly adjustment amount life-changing event. This is not automatic. That sentence is going to matter throughout this entire discussion. This is not automatic. Social Security may have accurate information showing what you earned in an earlier year, and still have no way of knowing that your financial life changed unless you report the change in the way the rules require. Consider a woman named Susan. She is 68. 2 years ago, she was still working and had a very good year. Her wages plus investment income pushed her above one of the Medicare income thresholds. She retires. Her income drops dramatically. But she assumes Medicare will eventually notice. Meanwhile, hundreds of extra dollars can leave her Social Security payment each month. The system is not necessarily making an error. It is using the information it has. This is one of the most important lessons I can give any retiree. Government systems often work from records, not from your current reality. The IRS sees the tax return that was filed. Social Security sees earnings and benefit records. Medicare premiums can be connected to income information. Banks see transactions. Credit bureaus see reported credit activity. None of those systems wakes up one morning and says, "Susan's life changed. We should review everything for her." You have to know which changes require you to claim a correction, request a review, or submit new information. Nobody is going to manage every connection for you. That does not mean the system is against you. It means the system is enormous. It operates through rules, databases, notices, deadlines, and automated calculations. Once you understand that, a lot of things that looked mysterious start making sense. The Federal Reserve affects the economy through interest rates and monetary policy. Those interest rates affect what banks charge borrowers and what savers can earn. The IRS administers federal tax rules. Social Security administers retirement, survivor, disability, and supplemental security income programs. Medicare has its own premiums and coverage rules. Banks operate under federal and state regulations and monitor transactions for fraud and other risks. Credit bureaus collect information reported by lenders and build credit files used in credit decisions. These systems communicate in some areas and remain completely separate in others. Your credit score, for example, does not determine how much Social Security retirement benefit you receive. A poor credit score does not reduce your retirement benefit. A credit card balance does not automatically lower your Social Security check. A bank seeing a large deposit does not automatically tell Social Security to cut your retirement benefit. Those claims circulate online because fear attracts attention. But that is not how the ordinary Social Security retirement formula works. At the same time, there are real connections you cannot afford to ignore. Your lifetime earnings record matters because Social Security uses covered earnings to calculate retirement benefits. Medicare income-related premiums can depend on tax information. Taxes on Social Security depend partly on your other income. Working before full retirement age can temporarily cause benefits to be withheld if earnings exceed the applicable limit. An overpayment determination can result in Social Security recovering money from future payments. These are real mechanisms, and they are more important than rumors. The first major revelation is this: if your Social Security deposit changes, do not begin by asking, "Did Social Security cut me?" Begin by asking, "Which layer changed? Was the gross benefit different? Did Medicare take more? Did federal tax withholding change? Did an income-related Medicare adjustment appear? Did Social Security withhold benefits because of work? Did an old overpayment enter collection? Was there a correction to your earnings record? Did a spouse or survivor benefit change? Did a pension-related rule that previously reduced benefits stop applying?" Once you identify the layer, the problem becomes smaller and more manageable. Imagine opening your banking app at 7 in the morning. You expected $2,100. You see $1,180. Your chest tightens. You start wondering whether a bill was missed, whether your account was hacked, whether the government changed something, whether you will have enough for the mortgage, groceries, medication, electricity, and insurance. That emotional reaction is completely understandable. For someone working full-time, a $220 difference may be irritating. For someone living on retirement income, $220 can change the month. That money may be the prescription refill. It may be the electric bill. It may be the amount set aside to help a grandchild. It may be half the grocery budget. After 40 years of getting up early, working overtime, paying payroll tax, raising children and saving whatever was left, people expect retirement to become simpler. Instead, they receive letters filled with words like adjusted gross income, withholding, reconciliation, overpayment, reconsideration, premium adjustment, and benefit computation. The natural response is to put the letter on the kitchen table and tell yourself you will deal with it later. That is exactly what I do not want you to do. A government letter does not automatically mean you are in trouble. A changed payment does not automatically mean money is permanently lost. But delay can remove options or allow a manageable problem to continue. There is a more intelligent way to respond. You slow the situation down. You separate the numbers. You identify the reason. You keep the notice. You compare it with the previous notice. And when the rule gives you a right to request review, correction, waiver, or a different repayment amount, you use that right. Now watch how this works with one of the most misunderstood Social Security rules: working while receiving retirement benefits. Millions of Americans retire from one job but continue earning money. Some take a part-time position. Some drive a school bus. Some work at a hardware store. Some consult for a former employer. Some go back to work because inflation made retirement more expensive. Others simply do not want to stop working. Many people assume that once they start Social Security, they can earn any amount without affecting the payment. That depends on age. If you are below full retirement age throughout 2026, the Social Security retirement earnings limit is $24,180. That works out to $2,040 a month if you think of it as a simple monthly average, although the annual rules and special first-year rules can matter. If you earn above the applicable limit before full retirement age, Social Security can withhold $1 in benefits for every $2 you earn above the limit. Imagine a 63-year-old receiving Social Security and earning $34,480 from work in 2026. That is $10,000 over the $24,480 limit. Under the basic rule, as much as $5,000 of benefits may need to be withheld because $1 can be withheld for each $2 above the limit. For someone receiving $2,000 a month, that is not a tiny adjustment. It can affect multiple payments. Now suppose the person reaches full retirement age during 2026. A different limit applies to earnings in the months before the month full retirement age is reached. For 2026, that higher amount is $60,160. Under that rule, Social Security generally withholds $1 for every $3 earned above the limit, counting only earnings before the month full retirement age is reached. Starting with the month you reach full retirement age, the earnings limit no longer applies. You can earn $30,000, $80,000, or $150,000 from work. and the retirement earnings test itself no longer reduces your Social Security payment. This is where another misconception causes unnecessary fear. Benefits withheld under the retirement earnings test are not necessarily gone forever. When you reach full retirement age, Social Security recalculates your benefit to give you credit for months in which benefits were withheld because of excess earnings. That can raise the monthly amount afterward. So when someone tells you, never work while receiving Social Security because the government takes your benefits, that is an oversimplification. The real question is when you claimed, what your full retirement age is, how much you earn, and how the earnings test applies to your situation. Here is the practical danger. Social Security often works with an estimate of what you expect to earn. If your earnings change and you do not report the change, payments during the year may be too high or too low. Your employer later reports actual wages. Social Security then compares the actual information with what was used. If too much was paid, you may eventually receive a letter saying you were overpaid. That word, overpayment, is going to become very important later because the rules for collecting an overpayment can have a much larger effect on your monthly check than a normal Medicare increase. Before we get there, I want to show you the opposite situation because Social Security corrections do not always take money away. Sometimes a record update can increase what you receive. Your retirement benefit is based in large part on your history of earnings covered by Social Security. If you keep working after you begin receiving retirement benefits, Social Security reviews working beneficiaries to determine whether new earnings increase the benefit. This happens because Social Security generally uses your highest 35 years of indexed earnings when calculating a retirement benefit. If a new year of earnings replaces a lower year in that calculation, your benefit can rise. Picture Robert. He started Social Security at 67 but continued working 3 days a week. Earlier in his career, he had several years with very low earnings because he cared for a sick parent. Now, his new earnings may replace one of those weaker years in the benefit calculation. Social Security reviews records to determine whether additional earnings increase benefits. When an increase is due, the agency can calculate the new amount and make the increase retroactive to January following the year of earnings after the record is reviewed. That means a payment can rise for a reason that has nothing to do with the annual cost of living adjustment. Most people never realize this. They assume every January increase is COLA, and every mid-year change must be an error. Not necessarily. Your benefit can change because new earnings were added. It can change because an old earnings record was corrected. It can change because another entitlement changed. It can change because Medicare changed. It can change because withholding changed. This is why I want you to review your earnings history. Social Security itself advises workers to make sure the record of yearly earnings is correct. An employer can report the wrong number. A business can change payroll companies. A name change can create confusion. Self-employment income can be reported incorrectly. Records can contain missing earnings. One year may not sound important, but one missing high-earning year can matter, particularly if it would otherwise replace a low year in your 35-year record. Imagine that your Social Security earnings history shows $18,000 for a year when your W-2 shows $68,000. That is not something I would ignore. I would gather the W-2, pay records if available, and the related tax documents and contact Social Security about correcting the record. There are time limits and exceptions around earnings corrections, so the earlier you find a problem, the better. One of the safest habits for anyone approaching retirement is to look at the Social Security earnings record before filing for benefits, not 5 years afterward. You spent decades paying into the system. Make sure the system has decades of the right numbers. If this information is helping you understand your own payment more clearly, leave a like. It tells me that explanations like this are useful to people who want the rules without the noise. Now we need to talk about something that affects retirees on both ends of the income scale: taxes on Social Security. I often hear one of two statements. Either someone says, Social Security is never taxed because I already paid Social Security tax while I worked, or someone says, the government taxes 85% of everybody's Social Security. Neither statement correctly explains the rule. If Social Security is essentially your only income, your benefits generally may not be taxable for federal income tax purposes. But when you have additional income, part of the benefit can become taxable. The basic federal calculation looks at what the IRS calls combined income. In simple language, the government takes half of your Social Security benefits and adds other income, including many pensions, wages, interest, dividends, investment gains, and even certain tax-exempt interest. For an individual filer, the important starting base amount is $25,000. For a married couple filing jointly, it is $32,000. Depending on the calculation, up to 85% of Social Security benefits can be included in taxable income. That does not mean the IRS takes 85% of your Social Security. I want to repeat that because this misunderstanding scares retirees unnecessarily. Up to 85% taxable means up to 85% of the Social Security benefit can be included in the income on which your tax is calculated. It does not mean the tax rate is 85%. Suppose a retired couple receives $40,000 a year in combined Social Security and also takes $45,000 from a traditional IRA. Half of the Social Security is $20,000. Add the $45,000 of other income, and you are already looking at $65,000 before considering other items involved in the tax calculation. The IRA withdrawal did more than provide spending money. It may have changed the tax treatment of Social Security. Depending on the full situation, it can also affect Medicare income-related premiums in a later year. This is one reason retirement tax planning matters. A dollar withdrawn from a traditional 401k or traditional IRA is not always just a dollar of income. At certain points, it can interact with another rule. A larger withdrawal might create federal income tax. It might cause more Social Security to be included in taxable income. It might eventually contribute to a higher Medicare premium. This is how retirement systems create what I call financial pressure points. Nothing illegal happened. The retiree did not make a foolish investment. The retiree simply crossed a line in a formula. Now compare that with qualified Roth IRA withdrawals. Roth rules are different because qualified distributions can generally be tax-free, which can make Roth money useful in retirement planning. But Roth conversions themselves can create taxable income in the year of conversion. So I do not want anyone hearing this and rushing to convert an entire retirement account tomorrow morning. A person with $500,000 in a traditional IRA who converts $300,000 without understanding the tax consequences can create a very large tax year. This is where good professional tax advice can pay for itself. The information I am explaining is educational. It does not replace personal financial, legal, or accounting advice. Your filing status, age, retirement accounts, state, work income, investments, Medicare status, and family situation can change the correct answer. But there is a new tax provision older Americans need to understand because it has created a lot of confusing headlines. For tax years 2025 through 2028, eligible taxpayers age 65 and older can receive an additional deduction of up to $6,000 per qualifying person. If a married couple files jointly and both spouses qualify, that can mean up to $12,000. The deduction begins phasing out when modified adjusted gross income is above $75,000 for an individual or $150,000 for joint filers. This helps both lower-income retirees and comfortable middle-class retirees, depending on their complete tax situation. But pay close attention to what this is and what it is not. It is a federal income tax deduction. It is not a new $6,000 Social Security payment. Social Security does not deposit $6,000 into your bank because you turned 65. You have to claim it through the tax process if you qualify. This is not automatic in the sense that you should assume every tax return automatically gets every deduction without the correct information being entered. The deduction can lower taxable income. That may lower the federal income tax a qualifying senior owes. It may increase a refund compared with what the person otherwise would have paid, but it does not directly rewrite the Social Security benefit formula. This distinction matters because I have seen people hear phrases like no tax on Social Security and assume their Social Security deposit itself should suddenly increase. Your monthly payment can still have federal income tax withheld if you previously asked Social Security to withhold it. Social Security allows beneficiaries to request voluntary federal tax withholding from monthly benefits at rates such as 7%, 10%, 12%, or 22%. Imagine a retiree who asked for 12% withholding years ago because he usually owed the IRS. His tax situation later improves, but he forgets about the election. Social Security keeps taking the requested percentage. The bank deposit stays lower. The retiree thinks Medicare or Social Security reduced the benefit. The deduction is actually federal tax withholding that he requested. This is why your benefit details matter more than your bank statement. Now look at how all of these rules can collide in one ordinary household. David is 68. His wife Karen is 66. David receives $2,400 a month from Social Security. Karen receives $1,500. They have a traditional IRA, a small pension, and a savings account. One year they need a new roof and help their daughter with an emergency. They withdraw $70,000 from the IRA. The money solves the immediate problem, but the withdrawal also raises taxable income. Their Social Security tax calculation changes, depending on the year and their total modified adjusted gross income. The higher income can also affect a future Medicare income-related premium. 2 years later, David opens his Social Security deposit and sees less money than he expected because more Medicare premium is being deducted. He has almost forgotten about the IRA withdrawal. The systems have not forgotten. That is what I mean by silent financial consequences. There is no person sitting in a room watching David. There is no conspiracy. There are records and formulas. A financial institution reports information that the law requires it to report. The IRS processes the tax return. Medicare income-related rules use income data. Social Security collects Medicare premiums from many benefit payments. A financial decision made at 66 can still be influencing the checking account at 68. That is why retirement planning is not simply asking, how much can I withdraw? The better question is, what else changes if I withdraw it? The same concept applies to capital gains. Suppose you bought stock many years ago for $20,000 and sell it for $100,000. The entire $100,000 is not necessarily taxable gain because your cost basis matters, but a significant gain can increase income for the year. That gain can affect taxes. It can affect income-related Medicare premiums in a later period. Selling your home can involve its own tax rules and possible home sale exclusions. Selling inherited property can involve basis rules that are different from property you bought yourself. An inheritance itself generally is not treated the same way as ordinary wage income for federal income tax purposes. But income generated by inherited assets and retirement accounts inherited from someone can create separate tax consequences. This is why I become concerned whenever retirees move large amounts of retirement money simply because someone online said there is a tax loophole. There are very few financial decisions that should be made from a 60-second video. A $5,000 decision and a $500,000 decision should not receive the same amount of thought. Now let us move to a group that deserves special attention because many people saw real Social Security changes after years of receiving reduced benefits. Certain public workers, teachers, firefighters, police officers, some federal workers, and other people with pensions from jobs that did not pay Social Security taxes were historically affected in some cases by rules known as the windfall elimination provision and the government pension offset. Those rules could reduce Social Security benefits for certain people receiving pensions based on work not covered by Social Security. The Social Security Fairness Act changed that. WEP and GPO no longer apply to benefits payable for January 2024 and later. Social Security processed millions of adjustments and retroactive payments after the law changed. This is not something that applies to every teacher, every firefighter, or every government worker. Many government employees already worked in Social Security-covered jobs and were never affected by WEP or GPO. But if you were affected by those provisions, the repeal was a major change. Think about a retired teacher who worked 25 years in a state pension system and also spent years in private employment paying Social Security tax. Her Social Security benefit may have been reduced under the old WEP rules. Or imagine the widow of a public worker whose spousal or survivor benefit was reduced under the old GPO rule. For an affected person, the repeal could mean a higher ongoing benefit and money owed for earlier months after the effective date. Most of those adjustments were processed well before 2026. But if you belong to this group and your benefit history still does not make sense, do not assume silence means everything was calculated correctly. Check the benefit information. Check the notices. Check whether the old reduction still appears to be affecting months when it should not. If you do not understand a calculation, ask Social Security to explain it. Nobody is going to care about a missing $150 in your monthly retirement income as much as you do. $150 sounds small when politicians discuss billions of dollars. To a retiree, $150 a month is $1,800 a year. Over 5 years, that is $9,000 before considering any other changes. Over 10 years, That is $18,000. That is why small monthly errors deserve attention. And the same mathematics applies in the opposite direction. A $50 monthly charge that you could have corrected becomes $600 after 1 year. A $200 monthly Medicare adjustment becomes $2,400. A mistaken $300 withholding becomes $3,600. Retirement money disappears slowly enough that people normalize it. That can be more dangerous than one dramatic loss. A person notices immediately when $10,000 vanishes from a bank account. They may not notice when $80 disappears every month for 6 years. That is $5,160. This is why I care about recurring deductions. Now I want to talk about your bank because retirees often confuse bank activity with Social Security activity. Your bank has its own responsibilities. Banks monitor accounts for suspicious activity, fraud, identity theft, money laundering risks, and unusual transaction patterns. Modern institutions use automated systems, rules, and increasingly sophisticated technology to identify patterns that deserve review. A $40,000 wire transfer to a new overseas recipient may receive more scrutiny than a $73 grocery purchase at a store you visit every week. That does not mean the bank automatically thinks you committed a crime. It means banks have compliance and fraud systems. The same thing happens with credit cards. A card company may block a purchase because the transaction does not match your normal spending pattern. You travel from Ohio to Florida and buy a $3,000 television. The card is declined. You call the issuer, confirm the purchase, and the transaction goes through. That is automated risk management. Social Security has its own systems for payment accuracy and records, but retirees should not merge everything into one giant idea that the government is watching the bank and changing benefits every time money moves. That is not an accurate way to understand ordinary retirement benefits. For Social Security retirement benefits, investment income sitting in your bank account does not normally change the basic benefit the way wages can affect the retirement earnings test before full retirement age. For supplemental security income, however, income and resource rules are very different because SSI is a needs-based program. This distinction is critical. Someone can receive Social Security retirement and have substantial savings. SSI has resource limitations. In 2026, the federal SSI resource limits remain $2,000 for an individual and $3,000 for a couple, subject to detailed rules about what counts and what does not. So when someone says, money in your bank can reduce Social Security, you must ask what program they are talking about. Social Security retirement, Social Security disability insurance, supplemental security income? They are not the same program. Confusing them creates terrible advice. Now tell me in the comments, did you already know that the amount deposited into your bank can be different from your actual Social Security benefit because several separate deductions and adjustments may be involved, or is this the first time someone has explained it this way? There is another quiet issue I want retirees to watch, especially now that federal payments are moving heavily toward electronic delivery. Federal benefit payments have been transitioning away from paper checks toward electronic payments. Social Security has been encouraging beneficiaries who still receive paper checks to move to direct deposit or an approved electronic payment option such as Direct Express, with limited exceptions available for people who genuinely cannot use the standard electronic options. For most retirees, electronic payment is faster and safer than waiting for a paper check in the mail. But every transition creates an opportunity for criminals. A scammer calls and says, Social Security is eliminating checks. Give me your bank account number now or your benefits will be suspended. Do not do it. A criminal sends a text with a link saying, your SSA direct deposit must be verified within 24 hours. Do not assume the link is legitimate. A person claiming to be from Social Security asks you to move money to a safe government account. There is no legitimate reason for you to transfer your savings to some stranger's account to protect Social Security. The safest habit is to initiate contact yourself. Use the official Social Security website by typing the address yourself or using a trusted saved bookmark. Sign in to your own My Social Security account. Call the official Social Security number from a trusted source. Do not use the telephone number printed in a suspicious text message, and never give someone remote access to your computer because they claim your Social Security payment is frozen. People who spent 40 years accumulating $200,000 or $500,000 can lose it in an afternoon because fear turned off their normal judgment. The criminals know the exact words that frighten retirees. Your Medicare will be canceled. Your Social Security number was suspended. Your benefits will stop. Tonight, your bank account is under investigation. You owe the IRS. You must act immediately. Real government matters can be urgent, but legitimate processes usually involve formal notices and defined appeal procedures. Panic is the criminal's weapon. A genuine Social Security notice deserves attention. A frightening phone call deserves verification. Do not confuse the two. Now let us talk about something more subtle: the date your payment arrives. For many people who applied for Social Security after April 30th, 1997, the payment date is connected to the birth date of the person whose record the benefit is based on. Birthdays from the 1st through the 10th generally correspond to the second Wednesday of the month. Birthdays from the 11th through the 20th generally correspond to the third Wednesday. Birthdays from the 21st through the end of the month generally correspond to the fourth Wednesday. Other payment arrangements apply to some people, including people who started receiving benefits under older rules or people who receive both Social Security and SSI. This matters because a payment arriving on a different calendar date does not necessarily mean the benefit changed. Months have different numbers of days. Wednesdays fall on different dates. If your regular deposit arrives on the second Wednesday, one month it may be the 8th, and another month it may be the 14th. That can confuse people who schedule bills based on a date instead of a payment pattern. The better approach is to know your Social Security payment schedule and keep enough breathing room in the checking account that a normal calendar shift does not cause overdraft fees. Banks can charge fees quickly when automatic payments hit before expected income. A retiree may have $2,200 of Social Security coming Wednesday, but the $1,600 mortgage payment leaves Monday. Now the account goes negative for 48 hours. One calendar mistake becomes a bank fee. Several automatic payments can turn one mistake into multiple fees. That is an example of the financial system hurting someone without any law being broken. The bank followed the account agreement. Social Security followed the payment schedule. The mortgage company followed the payment authorization. The retiree is the person caught between the calendars. That is why I recommend building a small cash buffer in the checking account, if your finances allow it. I am not talking about leaving your entire retirement savings in a low-interest checking account. I am talking about enough money to prevent ordinary timing differences from becoming expensive emergencies. Interest rates matter here. When Federal Reserve policy pushes market interest rates higher, savings accounts, money market accounts, and certificates of deposit may offer better yields, while credit card and borrowing costs can also remain painful. Retirees sometimes keep $80,000 in a checking account, paying almost nothing because they are afraid of investing. At the same time, they carry a credit card charging more than 20% interest. That is a dangerous imbalance. If you have $10,000 on a credit card at a very high interest rate, the interest can consume hundreds or thousands of dollars a year. Your Social Security COLA cannot outrun a 25% credit card. That is another uncomfortable truth about retirement. People focus on whether Social Security went up 2.8%, while ignoring a revolving balance charging 6, 7, or 8 times that rate. If a household receives $4,000 a month from Social Security, but sends $600 a month to credit cards, the retirement problem may not be Social Security. The problem may be the interest meter. That does not mean I am telling every retiree to empty emergency savings to pay debt tomorrow. Cash reserves matter. Medical expenses happen. Home repairs happen. Cars break. But high-interest debt deserves serious attention. The financial system rewards people who understand interest and punishes people who ignore it. Banks know exactly how compounding works. Credit card companies know. You should. Know too. Now we are approaching one of the most important reasons a Social Security payment can suddenly drop, and this is where ignoring a letter can become very expensive. Social Security sometimes determines that a beneficiary was paid more than the person should have received. That is called an overpayment. An overpayment can happen for many reasons. Someone works and earns more than expected before full retirement age. A change was not reported on time. Social Security used information that later changed. A family or survivor benefit was calculated using information that needed adjustment. The agency itself can make an error. An overpayment notice can arrive months or even years after the money was paid. Imagine you receive $2,200 a month. You open a letter saying Social Security believes you were overpaid $9,800. Your first reaction may be anger. I did not calculate the payment. Social Security did. That reaction is understandable, but your emotional reaction and the legal process are two different things. You need to read what Social Security says happened, how much it says you owe, the months involved, and what rights the notice gives you. If you disagree that you were overpaid or disagree with the amount, there is a process to ask Social Security to reconsider the determination. If you agree the overpayment happened but believe you were not at fault and repayment would meet the rules for a waiver, there is a waiver process. If the recovery amount is more than you can afford, there is also a process to request a lower amount of withholding. Most people think they do not qualify for relief because the letter looks final. A notice is not always the end of the process. This is not automatic. You have to act. Social Security's current rules for new Title II overpayments can allow a default withholding rate of up to 50% of the monthly benefit in many cases when collection begins, unless a different arrangement applies. 50%. Think about the impact of this. A retiree receiving $2,000 a month could suddenly be looking at roughly $1,000 being withheld for overpayment recovery under a 50% recovery rate. Someone receiving $2,600 could see around $1,300 withheld. For a household paying $1,200 in rent, that can be devastating. This is why I told you earlier not to ignore the word overpayment. A $1,790 Medicare increase matters. A 50% recovery from a Social Security benefit can change your entire financial life. If you receive an overpayment notice, do not throw it into a drawer because you are embarrassed or afraid. Read the deadline. Read the explanation. If you file a timely appeal or request for waiver under the applicable procedures, collection may be stopped while Social Security decides the request. For a request to change the rate at which an overpayment is being recovered from benefits, Social Security uses Form SSA 634. For a waiver of overpayment recovery, Form SSA 632 can be used in many cases. A waiver generally involves questions such as whether you were at fault and whether recovery would defeat the purpose of the Social Security Act or be against equity and good conscience under the applicable rules. Those are legal standards. They are not simply, I do not want to pay, so I do not want to create false hope. Not every overpayment will be waived. Not every appeal will succeed. Not everyone will receive the repayment rate they request. But there is a major difference between having a right and never using it. Nobody is going to file the paperwork for you merely because your rent is high. You have to claim the protection the rules give you. Imagine an 80-year-old widow named Margaret. Margaret receives $1,900 a month. Social Security sends an overpayment notice. She is frightened by the language and puts it under a stack of medical bills. She tells herself she will call after her doctor appointment. Then her sister becomes ill. Another month passes. Eventually the recovery begins. Margaret sees a dramatically smaller payment, and now the situation feels like an emergency. Compare that with Margaret opening the letter the day it arrives, calling Social Security using the official number, asking exactly why the overpayment occurred, checking whether the amount is correct, and discussing reconsideration, waiver, or a lower recovery rate if appropriate. Same notice, different response. That difference can protect a retirement budget. If you want to keep receiving calm explanations of Social Security, retirement, banking, and tax rules before they become expensive surprises, consider subscribing to the channel and turning on notifications so you do not miss the next one. Now I want to explain why overpayments can feel so unfair even when there is a real rule behind them. Automated systems are extremely good at processing millions of records. They are not always good at understanding what a changed payment means inside one kitchen. A computer sees an earnings amount. A retiree sees food. A computer sees a recovery balance. A retiree sees rent. A computer sees an income threshold. A retiree sees an extra Medicare charge. This is why financial literacy in retirement is not about becoming an accountant. It is about learning where the machine needs human intervention. You do not have to understand every line of the Social Security Act. You do need to recognize certain signals: a changed gross benefit, a new Medicare amount, a new IRMA charge, a federal tax withholding amount you do not recognize, a benefit withholding related to work, an overpayment. Notice: a missing year on your earnings record, a direct deposit change you did not authorize. Those signals deserve attention. And here is another thing I want you to understand about automation and artificial intelligence, because people hear these words and imagine something much more dramatic than reality. Financial institutions increasingly use automated analysis to detect fraud, review transactions, communicate with customers, and prioritize risk. Government agencies also use technology to process enormous quantities of information. But automated does not mean infallible. A computer can process the wrong information perfectly. If the input is wrong, the answer can be wrong. Suppose an employer incorrectly reports $60,000 of wages under your Social Security number when you actually earned $6,000. A system might accurately apply a rule to inaccurate data. The formula worked. The record was wrong. That is why the human check still matters. The safest retirement strategy is not trusting every computer and not distrusting every computer. It is verifying important numbers. Your credit report is another example. A lender can report an account incorrectly. The credit bureau can display the information it received. Your score can then reflect that record. The system may be functioning exactly as designed and still produce an unfair result because one piece of information is wrong. You dispute the record. The same mindset belongs in retirement. Verify before you panic. Challenge when the facts are wrong. Do not challenge simply because you dislike a correct rule. Know the difference. Now let us return to Medicare, because its interaction with Social Security is where many payment surprises begin. The Part B annual deductible in 2026 is $283, up from $257 in 2025. That deductible does not mean Social Security takes $283 from your check every January. It is part of what you may pay for covered Part B services before Medicare begins paying according to the program rules. This is a perfect example of why terminology matters. Premium is not deductible. Deductible is not coinsurance. RMA is not the standard. Premium. Social Security benefit is not the same thing as Social Security bank deposit. When people mix the words, they mix the decisions. A retiree calls Social Security and says, "Why did my deductible come out of my check?" The representative may not know what the person means because the person is actually asking about the monthly Part B premium. Use simple language if the technical term is confusing. Say, "My gross Social Security benefit is this amount. This amount was taken for Medicare. Last month the amount taken was different. Please explain why." That sentence gets you closer to the answer. Now imagine someone paying Irma whose spouse died. Household income changes. Tax filing status may change. The emotional loss is enormous, and the financial system continues moving. The surviving spouse may now be managing bills alone. A Medicare premium based on older household income arrives. This is exactly the kind of situation where SSA 44 may become relevant if the facts meet the rules. Nobody should expect a grieving widow to become a Medicare expert overnight, but knowing that there is a process can prevent unnecessary financial damage. The same applies after retirement. A 67-year-old executive earns $230,000 in the final working year. He retires. His income falls to $85,000. A later Medicare calculation still reflects the high income period. If the retirement qualifies as a life-changing event under the rules and the evidence supports the lower income, he may be able to request a lower RMA determination. Most people think they do not qualify because the IRS number was technically correct. The issue is not whether the old number was correct. The issue is whether the rules allow Social Security to use more recent information because life changed. This helps comfortable middle-class retirees as well as people living on much smaller incomes. Do not assume a rule is only for poor people. Do not assume a rule is only for wealthy people. Read what the rule actually says. Now let us talk about the biggest mistake people make with retirement accounts and Social Security timing. They treat each decision separately. They ask one person when to claim Social Security. Another person tells them how much to withdraw from the 401k. A tax preparer files the tax return. Medicare later calculates premiums. The bank holds the cash. Nobody has looked at the complete chain. I want you to picture a row of dominoes. The first domino is a $100,000 traditional IRA withdrawal. The next domino is higher adjusted income. The next can be more Social Security included in taxable income. The next can be an income-related Medicare premium in a later period. The next can be higher federal tax withholding needs. The next is a smaller amount available for spending. The withdrawal did not simply remove $100,000 from an account. It touched several systems. This is why retirees with significant traditional retirement savings need to think several tax years ahead. Required minimum distributions can eventually force money out of certain retirement accounts under tax rules. Roth accounts have different distribution rules for the original owner. Inheritance rules can change how quickly beneficiaries must take money from inherited retirement accounts. None of this means traditional 401ks are bad. For millions of Americans, a 401k was one of the best wealth-building tools they ever used. Employer matching helped people accumulate money they might never have saved on their own. The important thing is remembering that traditional retirement money usually contains a future tax obligation. You received tax advantages while contributing. The government generally expects tax when taxable withdrawals occur. Roth accounts reverse much of that arrangement. You pay tax earlier in exchange for potential tax-free, qualified withdrawals later. There is no magical account. There are trade-offs. Now think about inheritance. Retirees sometimes spend years worrying about federal estate tax, even though their estates are nowhere near the federal threshold that would cause an estate tax problem. Meanwhile, they ignore beneficiary designations on retirement accounts. A beneficiary form can determine where a retirement account goes. A will does not necessarily override the beneficiary designation on an account. That is a practical issue. Your bank account may have payable on death instructions. Your retirement account may have named beneficiaries. Your life insurance has beneficiaries. Your house may pass under different rules depending on title and state law. Your will controls certain property. A trust can control other property. The protection comes from coordination, not from fear. This is also why I tell people not to assume every inheritance creates federal inheritance tax. The United States does not have a general federal inheritance tax charged to every child simply for receiving ordinary inherited property. Federal estate tax operates under different rules. Some states have inheritance or estate taxes. Income tax can arise when inherited assets produce income, or when inherited retirement accounts are distributed. The details matter. Never move inherited retirement money casually. A wrong transfer can create a tax problem that might have been avoided. Now, I want to return to the Social Security payment itself because by this point, you can see why the phrase, "my check changed," is not enough information. Imagine you received $2,030 in December and $2,068 in January. You might conclude that you received only a $38 increase even though headlines talked about roughly $56 for the average retired worker. Your numbers are personal. Your Medicare deduction may have changed. Tax withholding may have changed. Your benefit before deductions may be different from the average. The national average is not a promise. It is an average. Some people receive $900. Some receive $2,500. Some receive $2,700. Some receive more than $4,000. The 2026 maximum Social Security retirement benefit for a worker retiring at full retirement age is listed at $4,152 per month, but very few people should hear that number and assume they automatically qualify. The maximum requires a specific earnings history. Your benefit depends on your own record and claiming age. Someone who earned $45,000 a year should not compare the Social Security check with a person who spent decades earning at or above the taxable maximum. Likewise, someone who claimed at 62 should not expect the same monthly amount as an identical worker who waited until 70. Claiming age matters. Starting retirement benefits before full retirement age can permanently reduce the base monthly benefit because you receive benefits for more months. Waiting beyond full retirement age can earn delayed retirement credits until age 70. There is no additional delayed retirement credit for waiting past 70. That does not mean everyone should wait until 70. Life expectancy matters, health matters, cash needs matter, employment matters, spousal planning matters, taxes matter. There is no correct Social Security claiming age for every American. Be suspicious of anyone who gives one answer to everyone. Retirement decisions are not slogans. Now here is the protection habit I promised you at the beginning. Every time your Social Security deposit changes by an amount you did not expect, compare 3 things before you do anything else. First, find the gross Social Security benefit for the month. Second, identify every amount removed before the deposit reached the bank. Third, Compare those deductions with the prior month or the prior notice and find the exact line that changed. I know I said I would keep this simple, and it really is simple. Gross amount. Money taken out. Reason for the difference. Do not begin with rumors. Do not begin with Facebook. Do not begin with a frightened neighbor. Begin with your numbers. Suppose gross benefit went from $2,000 to $2,056 because of the cost of living adjustment. Medicare went from $185 to $202.90. Nothing else changed. You now understand the basic difference. Suppose gross benefit is unchanged, but $240 suddenly appears as an extra Medicare amount. Now you investigate IRMA. Suppose gross benefit is unchanged, but $250 appears under federal tax withholding. Now you check your withholding election. Suppose gross benefit is unchanged, but $1,000 is being withheld because Social Security says you owe an overpayment. Now you read the overpayment notice and review your rights immediately. Suppose the gross benefit itself increased in June. Now you look for an earnings recalculation, corrected record, spousal or survivor adjustment, or another benefit change. Once you identify the category, you know where to look. This is how you turn panic into a process. And now we reach the most important part of this entire discussion. The financial system does not experience your retirement as one life. It experiences your retirement as a collection of records. The IRS has a tax record. Social Security has an earnings and benefit record. Medicare has enrollment and premium information. Your bank has accounts and transactions. Credit bureaus have credit files. Your 401k provider has retirement assets. Your insurance company has policies. Your county has property records. Your state has legal records. Every system sees a different slice of you. You are the only person who sees all of it at once. That is why nobody is going to tell you about every interaction automatically. The banker may not know your Medicare premium. The Medicare representative may not know you plan to sell a rental property. The tax preparer may not know you changed beneficiaries on an IRA. The Social Security representative may not know your household budget. The credit card company certainly does not care that your pension barely covers groceries. Each system does its job. You need to protect the space between them. This changes everything. Because once you understand that the danger is often not one terrible rule, but the interaction of normal rules, you stop looking for one villain. The real risk is the gap between systems. A person retires and does not update an income-based Medicare charge. A person works more than expected and does not update Social Security. A person withdraws a large amount from an IRA without checking the tax impact. A person receives an overpayment letter and misses the chance to respond before recovery begins. A person changes banks and gives direct deposit information to a scammer instead of Social Security. A person assumes a government pension still reduces Social Security even after WEP and GPO were repealed. A person fails to claim a senior tax deduction because he never asked whether he qualified. A person has 27 years of correct earnings and one missing high-income year but never checks. These are not dramatic financial crimes. They are ordinary administrative mistakes. That is what makes them dangerous. They look too small to deserve attention. Until you add the years. Think, about $100 a month. 5 years is $6,000. 10 years is $12,000. 20 years is $24,000. That is before investment growth, inflation, or opportunity cost. A retiree can spend 3 months negotiating to save $2,000 on a car and then ignore a $100 monthly financial leak for 15 years. Protect recurring money. That is one of the oldest lessons in personal finance. Now, there is one more piece I want to make absolutely clear because it involves one of the largest possible sudden changes to a Social Security payment. An overpayment recovery notice is not the same thing as an ordinary monthly deduction. If Social Security determines you were overpaid under Title II and the current default recovery rules apply, withholding can be far more aggressive than many retirees remember from earlier years. The default for certain new Title II overpayments changed to as much as 50% of monthly benefits. For someone living almost entirely on Social Security, that is enormous. Picture the system operating quietly. Your employer reports wages. Those wages enter the federal earnings record. Social Security compares the information with what was used to pay your retirement benefit. The system determines that the earnings test should have withheld more money. A debt record is created. A notice is generated. The notice explains the alleged overpayment and recovery. A deadline passes. Collection begins. The bank receives the next Social Security payment. The retiree sees hundreds or more than $1,000 missing. From the retiree's perspective, everything happened overnight. From the system's perspective, it was a sequence of data, calculations, notice, and recovery. That is the silent machinery I want you to visualize. This is why the most expensive sentence in retirement can be, "I will deal with that letter later." If a letter says Social Security believes you owe money, deal with it immediately. If the amount is wrong, challenge the amount through the proper process. If you were not at fault and believe the waiver rules apply, ask about waiver. If you owe the money but cannot survive a 50% reduction, ask about requesting a lower recovery rate. If you need professional help, speak with a qualified Social Security attorney, financial professional, accountant, or legal aid organization familiar with the issue. Do not pay a stranger from the internet to erase a government debt. Do not move money because a caller threatens arrest. Do not give your Social Security password to someone offering to fix the payment. Use official channels. Keep copies. Write down the date of every call. Keep the name or identification information provided by the representative when appropriate. Save notices. Save your W-2 forms. Save important tax returns. Save records showing major life changes. Paper feels old-fashioned until you need to prove something that happened 6 years ago. And digital records are useful only if you can still access them. Keep important retirement documents organized in a place your spouse or trusted family member can find if necessary. That is protection, not paranoia. Protection. I want the final message of this video to be very different from fear. You worked too long for your retirement money to become something you are afraid to look at. Open the notice. Read the statement. Check the account. Ask what changed. Learn the rule. Use the appeal when an appeal is appropriate. Use the waiver when a waiver is appropriate. Use the tax deduction when you qualify. Use SSA 44 when a qualifying life-changing event gives you a reason to request a lower income-related Medicare charge. Check the earnings record. Check your beneficiary designations. Know what leaves the bank account automatically. Know what interest your credit cards charge. Know how much cash you have available. Know what your retirement accounts are invested in. Know the difference between Social Security retirement and SSI. Know the difference between your gross benefit and the deposit. That knowledge will not make every financial problem disappear. It will stop many problems from surprising you. And at this stage of life, avoiding a financial surprise can be as valuable as finding a new investment. The worker who spent 40 years building a life should not have to become a tax lawyer at 70. You do not need to. You need a system. When your payment changes, identify why. When income changes, ask what other rules it touches. When a letter arrives, deal with it before the deadline. When someone frightens you by telephone, verify independently. When someone promises an easy financial loophole, slow down. When a bank or government calculation does not make sense, ask for the numbers behind it. You have more power when you understand the mechanism. The system favors people who know which questions to ask. Not because those people are wealthy, not because they know somebody in Washington, because they recognize that this is not automatic. A tax benefit may have to be claimed. A Medicare adjustment may have to be requested. An error may have to be corrected. An overpayment determination may have to be challenged. A lower recovery amount may have to be requested. A missing earning may have to be documented. Nobody is going to know your record better than you if you take the time to learn it. And if there is one thing I want you to remember tomorrow morning, remember this. The number in your checking account is evidence. It is not an explanation. If the amount changed, find the explanation. Sometimes the explanation will be perfectly normal. Sometimes it will reveal money you are entitled to. Sometimes it will reveal a deduction you authorized years ago. Sometimes it will reveal an expensive rule you need to respond to quickly, but you will not know until you look behind the deposit. You have already done the hard part. You worked, you paid taxes, you survived recessions, inflation, interest rate cycles, medical bills, mortgages, layoffs, and decades of financial decisions. Do not surrender control during the years when every dollar matters most. Protect your records. Protect your identity. Protect your cash flow. Protect your spouse from having to figure everything out alone. And protect yourself from the idea that because a computer produced a number, nobody is allowed to question whether the information behind that number is correct. The goal is not to fight Social Security. The goal is to receive what the rules say you should receive, pay what the rules say you should pay, and correct mistakes when they happen. That is responsible retirement planning. Share this video with a spouse, brother, sister, parent, friend, veteran, retired teacher, retired police officer, firefighter, or anyone approaching retirement who could be confused by a changing Social Security payment. One person understanding a notice before a deadline can protect thousands of dollars and months of unnecessary stress. And if you think this is important, watch the next video appearing on your screen. In it, I explain another financial situation that can quietly reduce the money retirees have available every month, how the rule actually works, and what you should check before assuming there is nothing you can do.